Back on the show, and it's time for Ask Annex. As always, got a question for us. You head to our website, annexwealth.com. Look for the Ask button. If we can help, Get Started is the button you want to hit. Matt Morzy, Investment Team Manager and CFP at Annex Wealth Management. Welcome back.
Hey, Danny.
Sarah Kyle's a Wealth Manager. Hello.
Hi, Danny.
First question today on Ask Annex. Is a 401k loan a decent option compared to a home equity line of credit?
Borrowing from a 401k isn't ideal, but it could make sense if you need some short-term money and you plan to pay it back in less than a year. Now, the key is short-term. Just some of the things that you want to consider, and that maybe some of the downside of borrowing from your 401k is that you have 5 years to pay back that loan, but if you leave your job or you get fired, you have 60 days that you have to pay it back. So you just want to make sure you're secure in your job. Secondly, that's double taxation. So now you're paying back this loan with after-tax money, and then when you take that money out again, it's going to be taxed. And the 401k is really meant to be in there for the long haul. So if you take money out, you could permanently damage your portfolio if you wait 5 years to pay it back, because all that money is not in the market growing and making that compound interest.
Next on Ask Annex, is being a huge fan of a product or company a reason to invest in it? I'm a huge fan of Apple, love everything about them, but it's also at or near an all-time high.
Great question, and something that gets brought up a lot to us. It certainly can be. Investing in what you know can be a powerful way to invest, or at least to give you an idea of what are some companies that you should look at to invest in. Our investment team, especially when we're looking at individual securities, kind of have three areas that we look at. What is the fundamentals of a company? What's the valuation of a company? And how is it trading? So fundamentals is essentially what you're getting for the company. So what's their balance sheet like? What type of margins do they have? Are they profitable or not? Is there a wide moat around that company? Valuations is how expensive is that company? So you have earnings, but how much do you have to pay to get those earnings? And then trading. What does the market think about it? Is it something that has momentum and is moving higher? Is it something that's choppy or not doing well? It's really important to know how expensive you're going to pay for it, because if you're paying a lot for those future earnings, your expected return going forward is not going to be as high as it used to be. So you really want to know what you're getting and how much you're paying for it to see if it's a good investment or not.
Just because a stock is at a certain price doesn't mean that it's expensive or cheap. There's plenty of stocks that trade at $3 or $5 that are overvalued, and there's plenty of stocks that trade at $200 that are cheap. So you have to do your due diligence and you have to do your research. You can't just blindly go, okay, this stock is making a new high, it's overvalued. And then keep in mind, if you like a stock and you really like it, just buy a little bit. And if that stock goes down, then you can buy some more. But if you want a stock, you wanted to get a little exposure, you just buy a little bit and then see what happens.
Yeah, that's a great point. Share price is somewhat irrelevant from a standpoint of what the company's worth, because some companies do stock splits and some don't. If a company's their share price is going to be too high, they might think they're pricing out a lot of investors, so they'll do a stock split and move it back down. But that doesn't change the value of the company. You're really looking at the market cap at that point, which is shares times price at that point to get the true value. But ultimately, you wanted to be able to divide whatever that value is by what earnings you're getting for that price you're paying.
Ask Annex got a question for us. Head to our website, annexwealth.com. Look for the Ask tab. Next up, am I unwise to concentrate most of the U.S.-based portion of my portfolio toward the S&P 500? What other indices should I consider that are U.S.-based?
Yeah, from a U.S. perspective, the S&P 500, it represents about 80% of the total investable market in the U.S. Now, it is a market cap weighted index, so companies that have high market caps, so like Apple, for example, is the largest company in the S&P 500 and the largest company in the world from a publicly traded standpoint. So they represent a lot. And then mid caps and small caps, a lot less. So from an S&P 500 standpoint, about 80% of it, just a little bit, is what you would consider the large cap universe with the United States. The rest of it is mid caps. There's actually no small cap exposure at all within the S&P 500. And when you look at the total investable market in the US, about 8% is small caps. So you're missing out on that portion of the market, really. The other part you're missing out is being able to tilt between growth and value when you're doing that. The S&P is a momentum index. So as companies do better, their share price goes up, the value, that market cap goes up, and it crowds out a lot of the other companies. So you're really playing what's doing hot, which is helpful when those things are doing really well. But if there's a sell-off in that market, you're going to see that reverse effect there. So you need to know what you're doing there. But ultimately, if what you're going to miss is mid and small cap exposure to the extent that you might want that in a diversified portfolio.
And we'll close the show with a little feedback on last week's Ask Annex. Just my 2 cents worth. Thanks for last week's advice for young people and the resumption of student loan payments. Nice job.
Thank you.
That's going to be something when all of a sudden that cash flow changes for those people that are paying back.
Yep.
Sarah Kyle, Wealth Manager, Annex Wealth Management, thank you.
You bet.
Matt Morzy, Investment Team Manager, thank you.
Thank you.